We saw signs that rising interest rates are starting to show up in the largest housing market in the country. Toronto saw home prices slide for a second month in a row as sellers came to the market. New listings surging by about 11%. Nevertheless, even with prices coming down, according to RBC, Toronto remains one of the least affordable markets, taking up about 80% of the average person's income to deal with ownership costs. Let's bring in Robert Hogue, Assistant Chief Economist at RBC, for some perspective. Robert, are you surprised by the slide that we've seen in home prices for Toronto?
Not surprised, no. I think it is a reflection of a rebalancing of the market after springtime that has been a lot more robust than probably most of us had expected. With prices rising for around five consecutive months. So the last 2 months, we've seen a little bit of rollback of that activity slowing down. And as you mentioned as well, we're seeing more sellers coming to market. So much more balanced market conditions that will cool down pressure on prices.
And do you view that when you see those kind of uptick in new listings, it's welcome from a supply perspective, because for so long people have not been willing to part with their homes? Do you see that as a sign of strain, of people buckling under the pressure of rising rates?
It could be. It could be. I think by now, we're all looking for those signs that higher interest rates are really pushing the limit, in many cases, probably beyond the limit of current home buyers homeowners. So, seeing new listings rising once again in August is probably a sign that some of them are just not have to put their homes on the market and move on, either downside or find some other housing solutions. And we'll be scrutinizing those numbers going forward as well, because for sure that the magnitude of the increase in interest rate since March 2022 has been such that that pressure must be tremendous from many current homeowners.
A lot of homeowners have been able to hang on and withstand rising rates because their amortizations have been extended, but that starts to run out of steam in a couple of years. Is it possible, are you thinking about the scenario of what happens if rates are in this higher for longer environment and they run out of the ability to extend amortization? Could that be a point where we're in for real downside in the housing market?
Well, for sure, I think that scenario, which is not our base case, by the way, would be one that would much more adverse outcomes in the housing market. That after years of a market that's been undersupplied, we could potentially end up with a period of oversupply if if the interest rate remain this high for significantly longer. Now, this is, like I said, this is more for us more of a risk scenario at this point than a base case. We do expect that the Bank of Canada will maintain its overnight rate at the current level, very close to that current level, over the next few quarters. But we do expect by the middle of next year, the bank will start to cut its overnight rate. So I think when we think of the medium term, this is our base case remains that we'll end up with a lower interest rate relative to where we are today.
At the average home price in Toronto is $1.15 million, and the work that you do suggests it's still one of the most unaffordable markets out there. How do you see that evolving, and where are some of the more affordable pockets starting to creep up?
Right, and those, maybe starting with the second part of the question, I think this is we're seeing in other parts of the country, right? We've seen Atlantic Canada, for example, is seeing a tremendous inflow of population largely out of Ontario, and as well in Alberta is seeing record levels of interprovincial migration as we speak. So clearly, the difference in affordability across Canada, Ontario being the least affordable, and especially the GTA, being up there, meaning that this is pushing many Ontarians and folks in the Toronto area to look for new places to live. Now, the outlook for affordability, as long as interest rates stay high, unless we see a very large kind of a scaled drop in prices, affordability, whether it improves a little bit or not, the bottom line is it's unlikely to improve that much. So those pressures, in our view, will persist, at least in the short term. And those population outflows out of the GTA, for example, are likely to be sustained over the next little while.